Let's bring in our market panel, though. Joining us now is Greg Branch, founder of Branch Global Capital Advisors, and Emily Roland, co-chief investment strategist at John Hancock Investment Management. Emily, I'll go first to you. We've seen some profit taking, a little bit of consolidation here with the S&P and the Nasdaq finishing lower, led in part by big tech names, by the semis, which have been on this record run. Are these still the places to be in this market, or should you be thinking about diversifying, especially as we have had market breadth so narrow?
Yeah, so we still are overweight the technology sector. We've been overweight U.S. tech companies for 5 years now. Certainly the valuations are starting to get challenged. You look at the forward PE ratio on the tech sector within the S&P 500 right now, it's at about 30 times forward earnings, which is the highest since coming down from the tech bubble. Certainly overbought to a certain extent, but the earnings are there. You look at tech earnings in Q1, they came in at 25%, much higher than the broad market. Analysts are penciling in about 15% for the rest of this year, 19% for next year. So yes, the PEs are elevated, but the earnings are there as well. These are high quality companies with great balance sheets, lots of cash. So we continue to embrace tech here, but we do think that you should own other stuff in case tech continues to potentially take a breather here. We look at areas like U.S. mid-cap stocks that are trading at their steepest discount to their large cap counterparts since the late 1990s. They've got outsized exposure to areas like industrials, which we see benefiting from fiscal spending and from onshoring activity that's taking place in the United States. So yes, tech, but we also want to look at U.S. mid-cap stocks as a great diversifier.
Okay. Greg, how do you see this market right now? We did have a softer batch of economic data again this morning. Jobless claims, not quite as high as last week, but still higher than expectations. Is bad news still good news for stocks because it signals the Fed could potentially cut rates and maybe more than is currently priced into the market? Or is the bad news finally becoming bad news because the economy is showing signs of turning?
I'm not sure where we are with that. Right now, I think my posture continues to be more bearish than bullish, although I think that, I always maintained that when the data led me out of that posture that I would follow. And we saw something last CPI report that we simply haven't seen in 2 years, which was a month-over-month core growth rate of 0%. And so one of my sticking points, right, for remaining bearish was that we were in this narrow band of 30 to 40 bips of growth every month, which did not get us on a trajectory for the 2% sustainable inflation rate that the Fed has targeted. More so, or adding to that, I guess I should say, is we saw our fourth quarter lead into our first quarter this year where many of the metrics that we're tracking accelerated, whether it's wage growth that moved from 90 bips to 120 bips, whether it's some of the PMI indicators, whether it was consumer sentiment, even the Fed itself on the SEP accelerated its view for inflation, its view for unemployment in a negative way. But much of that may be turning around now. And so while I was on the margin here thinking that it was more likely that they would hike than cut, I'm still maintaining my posture that we won't see any cuts this year. But for the reasons Emily said, I'm not sure that matters. We're getting exceptionally strong earnings growth right now. We had a 6% first quarter. If consensus is right, we're going to get a 9% second quarter. I think we've yet to enter the cycle. We will have a cycle that probably begins this year. So I'll be back to my bearish ways probably in the fall. But in the meantime, look for the things that are going to put up 20% earnings growth. Okay. Even as a bear, I said this. Look for the things that when breadth does narrow, the multiples won't really matter. We won't be considering things as expensive.
Well, Emily, what I'm taking away from both of you guys, I don't hear either of you pounding the table bullish right here. So should investors raise cash, at least some cash, in this environment, especially given that waiting for opportunities that'll earn 5%? Or do you need to stay completely invested as you make that move, perhaps from some tech investment into mid-caps?
Yeah, we certainly still think that there are opportunities in stocks, which I talked about. Again, U.S. tech stocks, U.S. mid-cap equities, but we're also looking at bonds as having the ability to do more heavy lifting in portfolios. Greg talked about this disinflation trend that we're seeing, and it's showing up. and things like the housing data this morning, building permits, new housing starts slowing significantly. We're seeing it in things like used car prices falling. We're seeing it in areas like the labor market showing weakness. It's a lot harder to find a job now if you've lost one. We're seeing job switching not result in wage gains like we had seen before. So the cracks are forming right now in the labor market. We do think the economy is going to continue to decelerate. Companies, especially low quality ones, are going to be challenged as the cost of capital remains elevated and they deal with margin compression as record revenue growth slows. So you've got to be really picky at looking at opportunities in stocks. Meanwhile, bonds haven't really sniffed out the disinflation trend yet. We're looking at 4.25 on the 10-year Treasury yield. We started the year at 3.88, so bonds are still under pressure. This is resulting in a very, very attractive entry point to us right now. The fact that you can sit and get paid income, 5 to 6% income in high-quality bonds and wait for this contraction to play out, to us is pretty awesome.